Supplemental Market Predictions, brought to you by American Monetary Association.
Indianapolis, Indiana, 32% return on investment 2011. Indianapolis has experienced repeated value fluctuations in 2009, resulting from the release of foreclosures into the housing inventory. When foreclosures were introduced into the market, they suppressed values and spurred capital inflows from owners and investors, which triggered the introduction of more foreclosed properties to capitalize on the uptick in values. These fluctuations have occurred within a relatively narrow value band and have significantly reduced the foreclosure inventory in the Indianapolis market area. Currently, approximately 16% of listings are from foreclosures. The Indianapolis market currently produces large levels of cash flow because of the strong market rents in conjunction with the market prices that have been depressed by foreclosures. Many of these foreclosed properties require additional capital for rehabilitation after the property is acquired. This results in the ROI mix tilting away from leveraged appreciation toward higher cash flow. Another opportunity for investors in Indianapolis is built-in appreciation from properties purchased below the cost of construction, as market prices regress toward replacement cost. Our preferred term for investments in the Indianapolis market are that of an income property bond, since much of the total returns come from cash flows. The superior cash flows produced in Indianapolis relative to many other market areas has produced some very unique economics. With a large inflow of investment capital from people seeking to capture higher rates of cash flow than properties in Indianapolis exhibit, it has facilitated a faster than expected regression from values back to the long-term equilibrium. The reason for this is because many foreclosure properties in Indianapolis were priced below the cost to rebuild them, in other words, the replacement cost. Outside of this phenomenon, Indianapolis is a very linear market where investors should expect modest rates of normal value appreciation in conjunction with the cash flow. Now, let's look at the ROI build graph for Indianapolis as we predict the following multidimensional return on investment. 3.7% appreciation, 11.8% ROI from leverage, and 16.5% ROI contribution from cash flow, for an overall total ROI estimate of 32%.
Brought to you by the Jason Hartman Foundation and the American Monetary Association. For more information, go to www.jasonhartmanfoundation.org or www.americanmonetarassociation.org.